How's it going, guys? Welcome back to the channel. Today we're going to talk about the portfolio theory. And so whether you're starting out or you're looking to refine your investment strategy, basically understanding portfolio theory can help you make smarter, more informed decisions, okay? Whether your profile is more conservative or aggressive. So I'm going to try to break it down a little bit and we can see how it works and tell you why it is still relevant to this day. So why was the portfolio theory developed? Basically, back in the 90s, this guy called Harry Markowitz, or he was an economist, Harry Markowitz, developed a portfolio theory to address the key questions. So basically, what is this question? How can investors balance risk and reward in their portfolio? So at the time, most investors focused on picking individual stocks that they thought would perform well. But Markowitz here, he realized that the real question wasn't just about finding good investments. It was about how those investments work together in a portfolio. Okay. So basically, he introduced the idea that by diversifying your investments, that is combining assets that don't move in the same direction at the same time, so they're not correlated together one another directly, at least, you can reduce the overall risk of your portfolio. So this was revolutionary back then, because it suggested that you could actually get better returns without taking on additional risk simply by spreading your investments across different assets. That's why diversifying is like really good. Okay, and basically, how does the portfolio work? So I'm going to try and break down like really simple terms. So basically, in the heart of the portfolio theory is the idea of diversification, right? So, but this isn't about owning a bunch of different stocks. It's more about owning stocks or other assets, okay, that behave differently in various market conditions. All right, so for example, if you own like both tech stocks and bonds, when the tech stocks go down, bonds might go up or at least not drop as much. So that's kind of how it works. So this way your overall portfolio doesn't suffer as much as it would if you're only invested in tech stocks. Okay, and not only that, but it suggests that you're going to diversify in multiple sectors, okay? And even geographically saying as well, like you can invest in multiple countries, whether it is bonds or stocks and many other things, okay? So that's pretty much it. So, and also he formalized like the concept that, he formalized this concept that he called efficient frontier, okay? So the first efficient frontier is this green line right here in this chart right here, okay, that represents the efficient frontier. All right, so basically you're imagining a graph with risk on their horizontal axis and their return on the vertical axis. All right, so the efficient frontier is the curve that shows the best possible portfolio. So those that offer the highest the highest return for a given level of risk, or the lowest risk for a given level of return. So portfolios that lie on this curve are considered efficient. And this would be like the efficiency of this portfolio right in this dot right here. Okay, so you can stretch it up, you can stretch it out a little higher to be riskier, or down to be safer. That really depends on you. Okay, but you should be somewhere between that line here with, I don't know, like maybe 75% with being conservative, or 25% being aggressive, or the opposite. It could be 25% aggressive, 25% conservative and 75% aggressive, but that really depends on you. Okay, so that's pretty much it. And the big question is the portfolio still relevant? And the answer in short is yes. Okay, so the portfolio theory remains the foundation of modern investment strategy, particularly in institutional investing. However, it's also widely applicable for individual investors like me, for example, you or anybody. So the core idea is that you can manage risk and improve returns through diversification. So it's valid today as it was when Markowitz first introduced it. Okay, so that's it. Markets have evolved, and so have the investment strategies. So while portfolio theory is a great starting point, there's also many other things and more economists and more people and more mathematicians that found more ways and more efficient ways according to the context of your portfolio and your profile and stuff like that. So that's pretty much it. Okay, that's just a very basic introduction to the modern portfolio theory. And I think this is smart for anyone who's trying to, like I said, build their portfolio. So if you want to build a portfolio for your retirement, or you make money from the internet and you need to create a portfolio that's solid, that is stable, that it's gonna actually gain the inflation over the years, because we know that over time we lose money due to the inflation. So we need to beat the inflation. We need to maybe some of you guys are building a portfolio for your children or your grandchildren or stuff like that, and you want to make sure that your family is well off in the future. And this is why it is that important to talk about these things, even in this channel that's talk about it, and especially in this channel that we're talking about entrepreneurship and financial independence. Okay, so that's pretty much it. I hope you liked this video. Sorry for any a word that I mispronounced or anything like this, but I'm doing my best here not to make any errors. Okay, eventually I'll make it, but it is what it is. At least if you got the idea, then that is good enough for me already. But it's pretty much it. So the only thing I ask you in return for this video is to subscribe to the channel if you enjoyed it, or like or comment or anything. And if you have anything to tell me, anything that like to teach me, or anything else that you'd like to add into this whole context, let me know down below. I'll be very happy to talk to you and answer you. So that's pretty much it. I'll see you in the next one. Bye.